We woke up this morning to very somber news indeed. A 20-year-old trader called Alex Kearns had taken his own life a couple of days ago. He had believed he racked up huge losses owing more than $700,000. The CNBC article zeroes in on the two possible reasons that ultimately precipitated his death. The first is the Robinhood trading platform he used to make his trades, and the second is complicated financial instruments like options trading. Now, while there were no details of his actual trading positions or financial statements, his cousin-in-law tweeted about the tragedy where he said Alex Kearns was interested in options and advised amateurs to stay away from exotic instruments like options and futures. There is already a lot of controversy surrounding the Robinhood platform, and I'm sure we could easily find criticisms about them. To be fair though, all brokerages have their problems. I personally do not use Robinhood, so this video will not focus on the Robinhood brokerage. Instead, I want to put my attention on the instrument that Alex Kearns supposedly used for his trades: options. In this video, I want to address the following question. How could a beginner options trader be exposed to such catastrophic losses? Personally, I'm surprised at the scale of his losses. $700,000 in losses is a huge amount for an amateur with an account size of only $16,000. How could this have happened? And if it could happen to him, could it also happen to all beginners who are exploring options trading? Since there are no details about his trade positions, we would have to make some guesswork. As Robinhood does not currently have futures products like crude oil or gold futures contracts, we will start by assuming that his options trades were stock options, meaning to say the underlying product is index stock such as the SPX, the SPY ETF, or company stocks such as Amazon or GoPro. A separate Forbes article says it's possible that Alex Kearns had a bull put spread position, which is a likely scenario. Later in this video, I will be explaining how the bull put spread might have caused him to misunderstand his financial position. But before that, it is important to establish some fundamental understanding of the exposure that an option trader faces. Every single option contract is paired with 100 shares of stock. As there is a 1 to 100 ratio between option contracts and shares of stock, options can be described as leveraged instruments. Unfortunately, the word leverage immediately leads the public to jump to conclusions about potential catastrophic losses. But dig just a little deeper and we will see that is quite far from the truth. Take options of GoPro stock for example. GoPro stock is currently trading at $4.54. As the stock price is low, the corresponding exposure to losses would also be low. Multiply the stock price of $4.54 by 100 and we are looking at a potential exposure of $454 per contract. Now suppose some terrible corporate news such as an FBI investigation hits GoPro and its stock price crashes a catastrophic 50% overnight. What sort of loss is an options trader exposed to per contract? The exposure is only $227 per contract, or 50% of 100 shares of GoPro. $227 is nowhere near the $700,000 in losses that Alex Kearns may have experienced. At this point, you might challenge this argument because one can simply buy 4,000 contracts of GoPro options to bring his total exposure to nearly $1 million. But that is like saying buying shares in GoPro has dangerous exposure if we bought 400,000 shares of GoPro itself. The point is, we have full freedom to choose the smallest size of our position, be it shares or options in GoPro. In fact, as you will see very soon, we have full freedom to choose the smallest contract size for our position, but we do not have that same freedom to choose large contract sizes. You might also be thinking that GoPro's exposure is small because it is a stock with a small stock price. So to address that, let's look at Amazon with a stock price of $2,653. Now the numbers are far larger, where one options contract has a potential exposure of $265,300. If Amazon stock crashes by 50%, we could potentially be making losses of $130,000. That is significantly bigger, but it is very uncommon for a stock to crash 50%, especially for a market behemoth with a huge price tag like Amazon. By comparing GoPro and Amazon, we then come to this undeniable conclusion. The price of the underlying stock and the number of contracts traded makes a big difference to our exposure. It is not true that options positions are inherently high exposure, but rather the options trader has the freedom to choose the right underlying stock with the right number of contracts to suit his or her risk appetite. If we want our options positions to lose no more than $50 on a typical day, trade one contract of GoPro options and stay far away from Amazon options. But even then, the exposure that option traders typically face can be further reduced. The most basic and probably the most popular amongst beginners is to choose to be an options buyer. Option buyers are insulated from catastrophic losses because they clearly know their maximum exposure. Their maximum exposure is whatever they paid for the option. Let me use Amazon options to illustrate this point. Suppose we want to buy options in Amazon and we choose the at the money call option. The price we pay for one contract of the options is $8,885. Since that is the price we are paying for the option, that is our max loss. Our losses when buying that option will never exceed $8,885. One of the first things that any options trader learns is options buyers enjoy limited losses and unlimited profits, which is what makes options trading so attractive. If options buyers have limited losses, what about options sellers then? Could options selling be the reason Alex Kearns accumulated so much losses? While it is true that option sellers are exposed to unlimited losses, it is also not likely that an amateur with a $16,000 account could chalk up $700,000 in losses. Remember I mentioned that one contract of Amazon options has $265,000 in exposure? What would it take for an option seller to lose all $265,000 in a single contract trade? For an option seller to make that scale of losses on one contract of options, Amazon stock would either have to crash from 2,653 to zero or to double to 5,306. That is just extremely unlikely to happen within the time before the option expires. Huge companies take years for stock prices to double or crash to zero, while most options trades are measured in days or weeks. So far, we have addressed three major points about options trading exposure. Let's note them down. 1. Options traders have full freedom to choose small stocks and small contract sizes. 2. Choosing to buy options would automatically limit the trader's losses to the amount paid for the trade, nothing more. 3. Although selling options has unlimited losses, the speed at which these losses occur depends on the size of the trade. You might then be asking, what about margin accounts? Wouldn't that be trading with borrowed money for even higher leverage? The answer is both yes and no. Yes, it is correct that margin accounts would grant us additional funds to place bigger trades, but there is also a limit to the margin provided. We can't expect a trader with $10,000 in his account to be provided with $1 million of margin to trade with. No institution would allow that level of reckless lending. Typically, we would be provided with up to 2 times the amount of cash we deposited into the brokerage account. So by placing $5,000 in an account, we are allowed exposure up to $10,000, but nothing more. Should the trader hit that limit, the brokerage will either demand additional fund top-up or they would forcibly close the position to limit further exposure. Furthermore, the brokerage platforms simply wouldn't allow a trader with insufficient funds to place trades with levels of exposure higher than their margin requirement. Alex Kearns had $16,000 in his account, and thus he wouldn't have been able to initiate a trade that would have exposed him to $700,000 in losses. Thus, we have our fourth point. All new options trades are subject to margin requirements, which typically only allow your account exposure to 2 times of the cash deposited in the account. Experienced options traders know that we can further limit our exposure by combining different options into an options strategy. A good example of this would be the vertical spread strategy, which is essentially buying an option that would act as a loss limiter. Mixing options contracts like this is commonplace among options traders, and strategies such as vertical spreads are simple enough for beginners to pick up quickly. One type of vertical spread is the bull-put spread, where the trade is bullish and has clearly defined maximum profit and maximum loss right from the outset. Vertical spreads like the bull-put spread are extremely safe for this reason. Options traders can freely choose between different options combinations to define their maximum profit and maximum loss before executing their trade. In this example, I have set up a bull-put spread on Amazon where my max profit is 1,080 and my max loss is 920. Everything is clearly spelled out before the trader takes the trade. Thus, our fifth point is, options strategies such as vertical spreads come with loss limiters clearly defined before the trade is initiated. You might have found the term bull-put spread familiar, and that is because the bull-put spread is the options strategy that the Forbes article says is possibly what Alex Kearns was trading. But yet the vertical spread is incredibly safe. So safe in fact that it is mathematically impossible for an amateur trader to be put into a 6-figure loss trading from a $16,000 account. So what could possibly have happened for that $700,000 loss to show up on his trading app? Here's what I think happened. As his cousin-in-law said, Alex Kearns could have misunderstood the financial statement from Robinhood. All options contracts have an expiry date, and when the contract expires, this options contract either expire worthless or are exercised into stock. When Alex's bull put spread expired, his bull put spread was making a loss. That week, the markets tumbled over 5% on a single session on 11th of June 2020. His bull put spread that was likely expiring the very next day might have been at max loss for the vertical spread, likely somewhere between a few $100 to $5,000 in losses. In his suicide note, Alex says that the puts he bought and the puts he sold should have cancelled out, which is exactly how the bull put spread works at expiration. The bull put spread consists of two options, one short option, which is the option that was sold and has unlimited loss exposure, and one long option, which is the option that was bought, which would have cancelled out those losses. What probably happened is that the Robinhood brokerage app showed the losses sustained by the short options at expiry, but have not included the options made by the long options, which would have cancelled out most of those losses. There might have been a slight timing delay before the long options converted into stock show up in his account. In other words, the profitable half of his bull put spread had not showed up yet. The brokerage platform thus showed only the losing half of his bull put spread, which was a huge six-figure loss. Had he checked the brokerage platform the following day, or perhaps on the next trading day, the other half of his spread trade would have settled and his account would have showed that his loss for that position would be the max loss of the spread, and nothing more. It is tragic that Alex Kearns took his life due to psychological trauma sustained from trading. If there is anything I hope to share in this video to beginner options traders, it will be these 5 points again. 1. Choose smaller stocks and small contract sizes. 2. Be the options buyer, not the seller. 3. The smaller your position, the slower the losses mount. 4. Margin requirements prevent you from being overexposed. And 5. Options strategies like vertical spreads protect you from undefined loss. There is no denying that options trading can expose traders to losses, but for the majority of us, our losses are limited to around 2 times of the cash we deposit into the brokerage account. That may be little comfort for the risk averse, but options trading isn't for the risk averse anyway. If you enjoy taking bigger risks for bigger rewards, options trading has been and will continue to be a very suitable financial instrument to kickstart your trading journey.